We are going to start with having Professor Calhoun from the London School of Economics start our next session, and then Jim Esposito, the co-head of the Global Financing Group at Goldman Sachs, will moderate a discussion with the Minister and the State Secretary for about a half hour or so. Jim will allow 10 to 15 minutes for questions from the audience, and so it's with great pleasure that I welcome our panel and our introductions.
Oh, good afternoon, ladies and gentlemen. I'm Craig Calhoun, director of the LSE, and it's my privilege to welcome our key speakers to the stage and to participate in this event jointly with Goldman Sachs. There could hardly be a more salient topic at this juncture in Europe, where capital flows have revealed themselves to be of systemic importance. And as you've heard, this event is so timely that the main speakers have been prevented from attending and send their sincere apologies. I suppose we will evaluate their sincere apologies in light of what they achieve in discussions with Greece today. However, they have also sent us two remarkable replacements who have very kindly stepped in at the last minute. Andrea Leadsom MP is the UK Economic Secretary to the Treasury, a job for which she is singularly well qualified, having behind her a very distinguished 25-year career in finance, including periods working in structured products, project finance, and fund management. She was called in by then Bank of England Governor Eddie George at the time of the Barings collapse to help settle the markets and avert bank runs. Having been elected as the MP for South Northamptonshire, she then distinguished herself as a member of the Treasury Select Committee. All of this must be invaluable experience that she brings to her current responsibilities, which include, among other things, banking and financial services reform and regulation, both at home and in the EU, financial stability and city competitiveness. Steffen Kampeter is Parliamentary State Secretary in the German Federal Ministry of Finance. He was elected to the Bundestag in 1990 as a Christian Democrat member in North Rhine-Westphalia, and since 2009 has represented Minden-Lübbecke. He took up his current role at the ministry in 2009, and before that he was the CDU-CSU budget spokesman. As number two to Dr. Schäuble in the Ministry of Finance, he has a special responsibility for budgetary matters and is a strong advocate of fiscal discipline and prudent debt management generally. He is a passionate advocate for the UK remaining within the EU. And with it just remains for me to hand over to Jim Esposito. Jim has had a long and distinguished career at Goldman Sachs, which he joined in 1995, and where he is now co-head of the Global Financing Group. Prior to assuming this role in 2014, he was the head of the EMEA Financing Group for 2 years. And before that, he was the Chief Operating Officer of the Investment Banking Division. Ladies and gentlemen, please welcome our panel.
Okay, thank you, Professor Calhoun. Let me start by describing the format for today's discussion. What we want to do is, first I'll invite both the Minister and the State Secretary to make some brief introductory remarks. I'll then follow up by trying to set the tone and frame today's discussion. And then I'll follow on by asking a series of questions to both the Minister and the State Secretary. We very much want to open the floor to questions, so I'm going to endeavor to leave about 10 to 15 minutes at the end of our discussion from any questions that the press or audience members may have. And with that, Minister, the floor is yours.
Thank you very much, and I'm delighted to be here. So thank you to the LSE and to Goldman Sachs for having us, particularly to be sharing a stage with Steffen today to talk about something very dear to my heart, which is the potential for Capital Markets Union to make a real difference to the need for growth, jobs and competitiveness right across the EU. And it's certainly true to say that the UK and Germany share the common objective of getting Europe growing again and of fiscal prudence, whilst at the same time reforms that can allow us to get these very important markets growing. Germany last year managed to achieve that superb goal of balancing their budgets, and our economy is growing slightly faster than Germany's. So that friendly competition remains, long may it remain so, but both our economies are doing rather better than the than the average EU economy. And so what we want to do is everything we possibly can to ensure that Capital Markets Union can contribute to a recovery right across the EU. And it's certainly the case that we in governments need to remain very vigilant, and that recovery will happen, is happening across the EU in a small way, but there are still big headwinds. There's a long way to go. And so I hope that Capital Markets Union gives us a real opportunity. Across Europe, we still have to take some very difficult steps to reduce the unsustainable debt levels. Germany has set to achieve a surplus this year, and the UK isn't too far behind, with forecasts predicting we could reach this milestone by 2018. But we need to look at how markets themselves can support growth. And as City Minister here in the UK, I want to focus particularly on the role of financial services in that recovery. So the Capital Markets Union initiative, launched last week by the European Commission, has the potential to be a real driving force underpinning economic growth and job creation. And it's true to say that right now, the European economies are far too reliant on bank funding alone. Bank lending accounts for more than 80% of financing in Europe, whilst in America, it's just 25%. That means that during the crisis, businesses were no longer able to access the financing they needed to invest and create jobs. And part of the success of the US recovery has been in the strength of its capital markets, allowing their economy to bounce back more quickly from the financial crisis that was rooted in the banking system. So I'm not here to advocate the US model, far from it. But what we can do in Europe is to find creative solutions that work right across from Bulgaria to Cyprus, from Ireland to Eastern Europe. And there is room to expand the role that Europe's own capital markets play in supporting both businesses and savers. It's about developing Europe's financial systems, making it more diverse, spreading risk around the system, and above all, making sure that European businesses can access the funding they need. And I want us to approach that with the same zeal that we've spent over the last 5 years trying to fix the banking system. But I do also want to be clear that's not always about legislation. And Europe can be too quick to legislate and to harmonise, rather than going with the grain of markets and looking at opportunities and creating the means by which the markets can create growth for themselves. We need to avoid the trap of thinking that there's a simple solution, of coming up with some simple pan-EU legislative framework that will magically result in cross-border trade. For example, the new fund structures created by UVECA and USEF have been much lower in terms of their success than was hoped for. We need to create a less burdensome approach with a maximum impact. That means bottom-up approaches, ideas generated by stakeholders, the financial services industry, as well as the companies that require finance. So, for example, the initiative led by the International Capital Markets Association to develop a pan-European guide for private placements is one that we strongly welcome. This draws on best practice from Germany, where issuance in their Schuldschein market totaled 9 billion euros in 2012. Some changes can take place quickly, such as reforming the regulatory framework for securitization, or reducing barriers, which mean it can cost a small business up to 600,000 euros just to create a prospectus, which is required to tap capital markets. Delivering this objective by 2019 is an important and ambitious goal. There's no magic bullet, but the consultation launched by Lord Hill last week goes a very good way to making a start towards building a financial system that better serves the needs of citizens of the UK, Germany, and every other member state. Thanks very much.
Mr. State Secretary.
First of all, thank you for the invitation. Andrea and I decided to rock the house because you seem to be, some seem to be disappointed that not Wolfgang and George are showing up here, but I think we are a much more attractive couple. So the second thing I want to say, most of the speech Andrea gave to you could have been given by me. I think Germany and the UK are very close on the issues on capital market union. we see this as a big chance and a very ambitious program for deepening the European integration. And it's not just about other things. It is about that we need functioning capital markets to foster growth and employment, which is the biggest challenge to the European integration. If you look to countries with where the spreads are higher and the youth unemployment is close to 50%. This seems to be that we have a multi-field task to foster growth and employment. But on the other hand, I'd like to make clear, despite this is just a conference on capital market union, this does not take off the pressure on the other reform field, which I would call structural reforms in many of the European member states, which only can, in combination with functioning capital market, can deliver to sustainable growth and rising employment. And therefore, I see that for the diverse financing needs and financing situation, the regulatory framework, which is meant to be set up by the debate at the end of the capital market union, is a good answer to deliver stability in financing of economics, especially on the SME field in this one. And therefore, actually, I praise or welcome or any diplomat, I give a positive statement to Lord Hill's proposal. I don't see it to be finished in the short term. The more concrete it comes, probably the more challenges we are. The priorities have to be debated. I think we can go deeper into that one, but I very much appreciate Andrea's notion on that high-quality securitization must be one of the first runners to be debated on that issue. Long-term project step-by-step approach is a clear message. I know all the market guys usually want us to immediately respond when they tell us something. This is not how politics is going. It is, if a long-term project really means a long-term project, probably some of beyond your investment perspective, but it's worth doing it and investing political efforts. And my final remark goes to subsidiarity and proportionality. It is not just we need equal financing situation all over the place in Europe. I'm not quite sure whether my honorable colleague from the ECB would have sent a similar message. They are much more concerned about fragmentation in the capital and credit markets than I would do. But it is not, there are some on the floor debating it that they look very much into the United States. And they see if things are going to be quite okay there, they can be easily transferred to the European Union. I disagree on that argument. We have to see that our economies and the needs of the SMEs are very much diverse. They are very much different from for example, US businesses. And therefore, we have to look especially on the subsidiarity question and see, go on with everything which improves the financial circumstances, but don't make an ideological debate, do everything Anglo-Saxon, which is positive. Look on a baseline economic analysis of, for example, differences in the SMEs, needs for financing all over the place, and then come to the conclusion. And this is what I mean when I'm talking about step-by-step approach and long-term project. It will not be easygoing, but it's worthwhile the effort. Thank you very much, Jim.
Thank you.
Thank you, Andrea.
Before jumping into some questions, I just want to make one high-level observation, because I imagine if you're new to this topic, you'd probably be wondering, why are we talking about capital markets union in an economy where the bank credit extension model has served Europe incredibly well? So I agree. I don't think we need to mimic or copy the US model. Banks have served the underlying European economy incredibly well over the years. But I think the important point to understand is something in Europe is changing, and we very well may be at an inflection point. And that's something that's changing is the fact that European banks' balance sheets will most likely continue to come down in size in the years to come. And I say that for a couple of reasons, not the least of which, if you look at returns in the European banking industry, most banks in Europe aren't generating returns anywhere near their current cost of capital. Equally, when you look at what's going on in the regulatory front, banks are being asked to hold more capital, more liquidity. And by the way, that's not a bad thing. I think there's no debate that the European banking system is much more stable, much more secure due to most of the regulatory actions that have played out the past couple of years. But banks are holding more capital. Banks aren't meeting their return on capital. And so if you fast forward this movie in the years to come, most market participants would argue banks are going to get smaller in Europe in the years to come. And that's why this bank-dominated credit extension model is a cause for concern. I just think that's important to bear in mind if you're wondering, why do we need to change? Why do we need to be a bit more open-minded in Europe in terms of how credit gets extended to the real economy? And with that, let's jump in. First question I'd like to direct actually at both of you. Both British and German economies have emerged from the financial crisis and are doing quite well. At the same time, financial systems in the UK and Germany have very, very different histories, with credit extension in the UK being dominated by the public capital markets, and in Germany, credit extension is much more dominated by the commercial banks. What role do each of you see banks playing in a capital markets union going forward? Minister, maybe we'll start with you.
Yeah, sure. I mean, obviously, there's the obvious role that banks play in capital markets, which is that where they have an investment banking operation, they're very much often the arrangers, the secondary traders, the market makers in capital markets. Where they don't, then they themselves may be the beneficiary of capital markets. So, for example, taking the securitization market, if we can get a decent European basis for regulation of the securitization market, that can offer a great means for banks to be able to get, for example, simple mortgages off their balance sheets to free up the capital space to be able to lend to the real economy. So actually it can benefit banks as users of the capital markets as well as players, arrangers and traders.
Thank you. Mr. State Secretary?
First of all, I'd like to take up your point why Germany and the UK, or UK and Germany, are growing so moderately positive at the moment. I think we're open to reform and change. I have a tremendous respect for what George Osborne and others did in this country to reform this. We've done it with a slightly different government approach after we have been accused to be the sick man of the euro by the economists, I think 10 years ago. So I think growth comes from reform and open to changes, which are necessary. Sometimes not easy to communicate to the electorate, but they are necessary because nobody is waiting for us if we do not reform. And the biggest challenge for Europe is to decide whether the call for competition made by the Chinese and other Asians and the Americans and countries we had on our balance sheet 10 years ago, like the Brazils, yeah? Do we answer this or do we resign? And there are countries in Europe, if I look to the Baltic states and if I look to Spain and Portugal, who have a clear answer to that. We reform our economy. We try to be more competitive. We want to contribute to this growth in Europe, and we want to take up the competitive challenge to others. And I think Germany and the UK did quite a good job. It may be that we have center-right governments and good leaders at the top, but on the baseline, it's openness to reform. The second answer I want to give to your question is, you raised a very good point to compare UK and Germany on the structure, for example, of SME financing. I raised the point of subsidiarity. Capital market union cannot be the instrument to destroy functioning capital functions of the German three-pillar banking system, which has a perfect fit to our SME family-owned businesses. This is something which is very crucial. I see it as a chance, for example, like Andrea raised the question of securitization, which is crucial to the German banking system and to the British one as well, to get more options for financing. If you have a level playing field on the regulatory framework to deliver that, and you don't have limits to that, and you have restrictions of it, but you have no regulatory borders to cross over, this probably is the answer.
Do you think you have a false sense of complacency, just given the unprecedented amounts of liquidity that are being pumped into the capital markets from the big three central banks? So capital markets are functioning well. SMEs are getting funding in Germany in the current backdrop. but are we living in a bit of an artificial liquidity condition thanks to the unprecedented actions of the central banks? What happens when we get to the other side of a post-QE world?
You come from the financial markets. I come from the real economy. I'm an economist by profession, and I would say my answer to you is we have to be more competitive, and we have have a level playing field that our financial markets, as an instrument to support competitive industries and companies to do that. And I share your analysis that at the moment we don't have problems of liquidity. But the framework has to not to deliver a good positive contribution in this overflow of liquidity circumstances. If we go on to normal, or whether this is the new normal or not, I'm not going deeper into that one, to the old normal situation, at least we have this regulatory framework more necessary than we have it today, and we shall use the time now where we're not crunched with liquidity to change it. This is the historic, not historic, but political gap we have to jump in, and this is where I see the benefit of the proposals of Lord Hill.
Yeah, I would echo that comment. I think the central bank intervention is meant to be a bridge to the other side. We've avoided a violent round.
Did I say something about central banks? No, I usually don't.
We've avoided a violent round of bank deleveraging, which is exactly the proper public policy response. But we do need to get on to a round of managed deleveraging in the banking system. So now's the time to really be having this discussion. Minister, I want to come back to you. A lot has been done to put the European economy on better footing, but Europe still faces many challenges. What is a capital markets union? We've been bantering this term around a lot today, but if you're able to define it or how you think about defining it, that would be helpful. And how will a capital markets union deliver real economic benefits to the people of Europe?
So for me, capital markets union could be a single market for capital. So as opposed to it being some attempt to create a new regulatory environment or something, it should be literally about creating the right framework for growth and jobs and prosperity, which means access to finance. I mean, ultimately, what creates jobs and growth is businesses, predominantly small businesses, actually, in terms of the number and the number of people they employ and so on. Small businesses are the lifeblood of an economy. They have to gain access to finance. The big problem, as I mentioned earlier, is that because of this more than 80% dependency on bank finance, the European economies are incredibly dependent on the vagaries of banking liquidity, capital, ability to lend, leverage, and so on. So what's happened over the last few years has been a disaster for SME access to finance. So ultimately, Steffen's already mentioned this, what this has to be about is how do you get money into the real economy? And so Capital Markets Union is exactly that. It's creating a single market for capital that facilitates money coming into the real economy. And it's not to replace bank financing as such, it's to create a bigger pool. So it's an additional source, whether it's through private placements, whether it's through businesses accessing stock markets, whether it's through pan-European products that are sold by intermediaries with some kind of common basis across the EU that provides greater access for savers as well as those who need to borrow money. So for me, Capital Markets Union is just a huge opportunity to expand on what we already have. And so just to put one number on it, I understand that the Commission themselves have said that by restarting European securitization markets alone, we could unlock 300 billion euros of funding for European businesses beyond what's already available. And of course, since the financial crisis, we have seen a massive decline in capital flows, not just from outside Europe into Europe, but also within Europe. And that's what Capital Markets Union should unlock.
So you mentioned securitization in there, and I'm curious if either of you or both of you have a thought on the importance of revitalizing European securitization markets going forward. It would strike me that that's a place of getting funding towards European households or the European consumer, potentially additional funding for SMEs. Securitization went through a very difficult period given the US experience. Where are we on securitization? What's your view? How important does it need to be going forward in Europe?
Why has the market been drying out? Because the people don't trust in these products. So trust seems to be the key issue to remobilize the securitization, complicated word in English, this market. But so the question we're debating on the European level is, how can we define high quality securitization things? And this will be one of the central points where we shall start. I think the UK and Germany have the same perception what is key, and this seems to be key. Let's go on to define that and bring trust back into the market. But I'd like to raise my point again. It's not just about trust in securitization, it's general trust in that countries and companies are willing to compete and be more efficient and going more to the customer and redefine, for example, themselves new. This openness to technology, another question. It's not just about financing activities, it's about the question whether you have competitive activities in general. So these are two sides of the medal we have into consideration as well. This is why I raised the point that capital market union is necessary, but structural reforms and enhancing the competitive within the European Union, especially in some of our problem fields or problem countries, is crucial. And if you don't answer both questions, you will not have sufficient growth and employment as we both required here earlier.
I think that's very fair. You know, we've talked a lot today about the credit crunch, places where users of capital, users of credit are having difficulties accessing the capital markets for the growth they need in their companies. But to have a functioning capital markets, you really need to do a good job of matching buyers off with sellers. So I just want to ask the minister a question about the buyers of financial assets. Europe actually has a great benefit. It has significant pools of capital. Some of these pools of capital are a bit trapped, a bit compartmentalized, more so than in the US. Can the Capital Markets Union be a vehicle by which European savings is put to better use by offering investment choices and portfolio diversification to savers? And I really want to get at the heart of the retail investor, because clearly there's been a lot of good regulation put behind retail investments, yet some of that capital is not finding its way to growth-oriented companies into all parts of the capital markets. So I'm curious how you think about that.
Yeah, I mean, this is a very tricky area. And I mean, I'm not a big advocate of, you know, as I said in my opening remarks, of let's create a new regulatory regime in which everybody sticks everything. You know, it's not about that. What it is about is sort of learning from best practice in different areas. So take, for example, the German Schuldschein market, which is a huge success. You know, that's something that perhaps other EU member states can learn from, and perhaps we can create a pan-European private placement market. I know ICMA have made some efforts to create a common documentary platform for that could enable more money to be diverted into a pan-European private placement market. The same is potentially true with securitization. There is potentially the opportunity for that, or even for better pan-European use of UCITS, for example. But I would just say again, we do have a number of directives, and in fact I even have a list of them here. I can read them out if you like. That we feel in the UK have been overburdensome. They've sort of been a regulation looking for a investor flow rather than the other way around. So I do think that, you know, in some of this work we need to look very carefully at what we've already signed up to and whether we can actually, by making regulation less burdensome and more going with the grain of what capital markets are already there and what best practices, whether we can actually develop investor appetite more. So for example, in insurance mediation, in some of the retail investor directives where perhaps a shared basis for transparency and information flows could be generated whilst you could still retain features of domestic markets. But I mean, all of these things are in play, and I certainly do think that Capital Markets Union offers the opportunity to attract retail savers into a more pan-European capital markets environment.
Yeah, I think that's right. I would just echo one thought, and you mentioned UCITS. I find it somewhat curious in Europe that the retail investor, given UCITS restrictions, is actually prohibited from investing in the below investment grade rated loan product. So we talk about Europe moving from a bank loan product more to a capital markets. I think we should be a bit more precise. In the States, there's a much deeper, much more liquid institutional loan market. That institutional loan market is much smaller in Europe. It's a fifth of the size as it is in the US, given retail restrictions from investing in below investment grade rated loans. Areas like that, there may be some places where we could relax certain restrictions and broaden and deepen the market. Mr. State Secretary, do you agree that a capital markets union is not only about steps to liberate new sources of financing, but just as importantly, to create an attractive investor environment? I'm also curious if you could just address the question of why is Europe a good place for an investor to put their money?
If you look all over the world, first of all, we are stable. Mm-hmm. Yeah, actually, I think the question whether you have a thin line between risk and uncertainty. I think was it Frank Knight or something like that? So this is the question where I say you have a proper, stable economic surrounding. Second issue, I would say, we understood the message. We are not completely behind the curve. We know that we have to be more competitive with new players on the world. And the third thing I would say, we are very much innovative. If you look at the debate in Germany, for example, with Industry 4.0, which is the integration of the internet in smart factories, new products. Actually, the European industries are much ahead of the curve, integrating new technologies, and this gives future opportunities to many. If I see how the car manufacturers industry, European-wide, has changed during the last 10 years, or the machine building industry, chemistries and others, I think we are much more the innovation drivers than others out of Europe. Look at it. These are three arguments I would raise against the foreign investors. And finally, I would say something, we fix our problems. If you see the latest debate on Greece, actually there have been 3 weeks, probably more uncertainty than risk, but we finally did it. This is politics. It's not like what an investor likes, that politicians are debating some issues and not fix it immediately, but we finally fix it. The rule of law is back on track. We're bargaining, and our currency framework is stable. We changed it completely. We found it within the Eurozone. You're not entering, are you? No. Within the Eurozone, a stable environment with the banking union, in addition to the European monetary activities. I think if I compare that with the debates 5 to 10 years ago when I was in New York and explaining investors going into Germany or going into Europe, I think we have fixed this is the fourth argument. We've fixed many things which we were criticized before. So Europe is a good opportunity. Why not?
I'd like to open the floor to questions in just a moment, but no conversation on European markets would be complete without a question around politics. Germany and the UK, Mr. State Secretary, I'll direct this at you at least at first. Germany and the UK have historically been strong supporters of the benefits of an EU single market, and you're here today to provide support for the deepening of that single market through the creation of a capital markets union. How important is German-UK cooperation in promoting a common vision of the EU, and what would be lost for Germany specifically if the UK were to exit the EU?
First of all, we have much in common. We're free traders, we're open to innovation, we do not love bureaucrats. We are fiscally conservative. We want to bring things through. we think TTIP is a good idea, and CETA, and all. There are many fields which are of politics which are debated on the European level, where Germany and UK have similar positions. This is not completely sound to every detail. Sometimes there may be floor to debate, as always. But we see the UK as a natural partner for many things where we see room for improvement within the European integration. And we don't want to lose them.
Thank you. Minister, do you care to respond to that?
Of course, yes. Yeah, I mean, I think that the EU has to reform, and I think that all EU leaders recognise that. And that's not necessarily in the sense of reform of the institutions, but reform in order to grow and thrive and get back onto an economically sustainable path. And of course, the headwinds show us that the EU's global share of GDP is falling quite fast, and that, you know, there is a lot of ground to make up. So actually, doing nothing isn't an option. And I would absolutely agree with Steffen that the UK and Germany work very closely together. We certainly agree on most things to do with growth, our hatred of bureaucracy, our desire to see our economies strong and sound, structural reform and so on. So we work very closely and very well, I think, with Germany. We certainly see Germany as big allies in that. And so, you know,
There's
really...
one thing where we contradict, it's soccer.
Yeah, that's true, actually. I could probably think of some others. But more feminine. But no, seriously, I think if Britain wants to be part of a strong and growing Europe, and that's what really our focus is on, trying to ensure that that's going to be the case, isn't it?
Yeah.
Yeah, exactly, and we can agree on that.
Thank you both. We have about 10 minutes. I'd like to open up the floor to questions. I'd ask to state your name and your affiliation, and then we'll take your questions. Why don't we start here in the front, number 3?
Charles Grant from the Centre for European Reform. If I understand correctly, both the British government, probably the German government, and Lord Hill all believe that the Capital Markets Union should be decentralised, bottom-up, without too many new pan-European regulatory structures. But we heard Yves Mersch say on the previous panel from the European Central Bank, it won't work without pan-European supervision. The view of the European Parliament is they're not going to pass any of the requisite measures unless the Commission proposes the creation of new supervisory bodies at EU level to ensure convergence of the different national systems and rules. So the question is to the two ministers, is it really feasible to build this decentralised, subsidiarity respecting capital markets union? Surely if you really want it to go ahead, you'll have to create some sort of new supervisory bodies at EU level.
Yeah, okay. So I don't agree with that, Charles. I think that what our position is that the EU regulators should be strategic level regulators who are looking to ensure that there is a consistent level of regulation, to be looking at the top level, not doing the day-to-day job of national competent regulators. And so our view is that it is perfectly possible to create a capital markets union without creating new regulators to oversee the whole thing.
And I think I talked earlier about the step-by-step approach. This is work in progress. I don't see a need for immediate action. If you see a problem or a challenge, don't answer always with the new institution. Just I stated before that we have an in-depth economic analysis on where are the needs, where do we have to go on. But on the other hand, we shall be open to the answers. But first, I would say just look on the facts and not give an answer which may be at the end of the process.
Go ahead.
Thank you. Simon Lewis, AFME. We've just issued a report today called Bridging the Gap, which looks at the relationship between, or what we can learn from Europe, from the US capital markets. And many of the ideas have been touched upon during the sessions this afternoon. Better use of private placement markets, opening up finance for small businesses. I think there's one area politically that's of great interest, which is the treatment of pensions, and whether politically, and I'm interested in the Minister's views on this, whether Europe is ready for a fundamental reform of pensions, because one of the lessons from the US, given the tradition of self-investment and risk, is that those trapped pools of savings that you referred to can be released through the pension system. But I think it will require politically in Europe quite a different change of philosophy in terms of thinking about pensions. So just interested to hear what the ministers might think in terms of the political appetite for changing the approach to pensions.
I jump in first
Sure.
because this is not an economic but a political question. Whether you have the challenge for demographics, especially in my country, is more challenging than the appetite for reform the system. And therefore, actually, we make a reform break for this legislation period, and we went into a more sideward movement, but I'm not quite sure that this will be a sustainable answer. On the other hand, the reforms of pension system have to be politically sensible. You can not just jump in like with a Texan cowboy way of doing it, saying, oh, you're not the demographics challenges. So it will be a step-by-step approach, but debating that not just only in Germany, but all over Europe, I think the awareness of the policymakers for continuous change and continuous answer to the demographics have been improving. We have a high learning curve over the last 10 to 15 years. But this is not an announcement for anything special and concrete and something like that. But we have to be aware that this problem is growing, and it does not only relate to the pension system. I know that national health service is a very challenging issue in countries, so I'm not only talking about Germany. We are expecting our costs not just only because of the demographics rising in the pension system and the needs for further funding in the healthcare system is quite obvious, and we have to debate that seriously parallel. So it is about the bloody demographics, and this is a challenge.
Yeah, well, I think you make a very good point, Simon, that unlocking savings, unlocking investments could be done by looking at the pension system. But I go back to where I started, saying that European member states have a lot to learn from each other. And whilst I think we could all learn a lot from some of Germany's expertise in private placements market, for example, at the same time, perhaps other EU member states might like to look at what we've done on auto-enrolment, for example, on pensions. Doesn't mean we have to have some kind of European pensions market, which I would personally not like to see considered. That would be an extremely difficult territory to get into, but certainly EU member states could look at unlocking a huge amount of savings potential, as well as ensuring a better retirement for their own people by actually looking at some of those ideas that other countries have put forward for their own.
My cautious answer, I want to add something. It has something to do with our pension system is not very much capital market oriented, but intergenerational finance. Okay, this shall be clear, shouldn't it? And but we're going out of this, and therefore actually the capital market side probably will play a bigger role in all these countries where the state is step by step during reducing for demographic reasons the average pension, and there's room for maneuver for private precautionary action. There the capital markets can probably step in and will step in.
In the back, number 3.
Kevin Daly, Goldman Sachs. It's true to say that, I mean, Germany and the UK have been clearly the most successful large European economies, but one clear distinction between them lies on the imbalances side, where you've had, Germany has a very substantial current account surplus of 7% of GDP. The UK has a very substantial current account deficit of 6% of GDP, as it marks a very clear distinction between the two economies. What can and what should, in your mind, be done to address these imbalances on both sides?
First of all, the Eurozone as a whole is balanced. If you switch from the national and from the European point of view, step by step, it's balanced. So we have internal imbalances, but not as a currency union imbalances to others. So second, I'm always blamed being competitive, and I usually ask in the audience who's buying a German car, and then in financial markets seems to be that German cars are very attractive, and we always have a majority. And then I'm blaming you causing these imbalances. The question is, the question is, can we do more for private demand? This is to take it more seriously. The wages are rising. Our labor unit costs are rising as well. Our relative competitiveness is shrinking. But what the hell is the ECB doing now? Huh? I can work hard on stabilizing private demand, talking with our unions, limiting payroll taxes, just to be internally imbalances. But I can't work as hard as the ECB is reducing the value of the euro currency. And then I'm back in the point that probably our surplus will rise because of low oil prices and currency effects. I'm not blaming anybody for anything, and I'm not commenting ECB action, but I can't work as hard as our attractive exports are bought by or bought abroad. I can't do that. We are aware that this is not a general notion that there's one surplus and many deficit countries. But in general, at the moment, I don't see this tendency, as long as it's not politically manipulated by the German government or others, to be solved. But please take into consideration the Eurozone as a whole is not a destabilizer. And with our imports, by the way, we contribute growth to Eastern European countries as well. If I go to Slovenia or Slovakia, they are much more interested in German growth rate than the Germans are, because of their direct interconnection between their exports to Germany in the general supply chain. So this is not a sufficient answer, and I don't blame you for buying German cars, but probably the surplus will stay, and we will work hard on stabilizing and enhancing private demand. We are quite well aware that this is one of our tasks to get internally more stabilization in the system.
Yeah, I don't think I'm going to be able to give you a satisfactory answer either. I think what the UK government has done has been very much to focus on improving our export markets, and in particular, I think in the financial services sector, what we've done is our economic and financial dialogues have actually generated a huge amount of growth. We've been some of the sort of strongest proponents of the free trade agreements, particularly of TTIP, which is something that we've taken as a real priority. Our economic and financial dialogue with China, and some of the measures we've taken to, for example, issue UK government debt in renminbi and in sukuk to try and generate greater links, greater ties, greater markets and so on in those areas. But generally speaking, we've also focused on UKTI measures to improve our exports, to try and encourage greater inward investment and to try and rebalance our economy. So, it's difficult, and we are taking every step we possibly can. I think we've done more than most governments could have and would have done, and you'll have seen that the Prime Minister himself has led a number of trade missions to try and improve the amount of trade that we're doing and finding new export markets. And I think we have had some success, starting from a pretty low base. We've had some very impressive growth percentages.
We have time to take one more question.
Paul de Gouwer from LSE. I would like to follow up on the question that Charles raised about the need for institutional build-up together with capital market union. I was a little bit surprised by the answer you gave, both of you, that that's not really necessary. It reminded me of what happened at the start.
This is not
Supervisor,
correct. We did say something else.
Okay.
We did not say that is no.
You said the strategy is today. We don't need to do that. This will come in the future at some point, maybe. It reminds me of what happened at the start of the Eurozone when we forgot to create a common supervisor for the banking system. And at that time, policymakers had the same answer. That is, well, we start now, and this will come about. We learned the hard way how this comes about, right? And the question I have, how do you see this coming about in a different way than what has happened with the banking union?
Shall I have it?
It's my
Okay.
case, sorry.
Yeah. Be my guest. I'm just trying to help you out.
No, actually, you can't compare these two,
Yeah.
Paul. This is something completely different. It is not about a common currency and the convergence of financial and economic situations. It is something. It is a new framework where it is like. Probably more like a free trade zone for the capital market, as Andrea put it, and you should not legitimately compare it with the establishment of a common currency. So my answer to this is you have to treat different things differently.
Yeah, I completely agree.
And this is 0 now.
Thanks to Jim, thanks to our panelists. The LSE is very proud to have been able to link up with Goldman Sachs to put this event together. A key part of our mission at LSE is to ensure that research continues addressing the evolving challenges that we face, particularly at the international level. Europe has some serious problems. They have been just hinted at very gently, in some cases, in the conversation, but I think LSE and Goldman Sachs offer a formidable combination, as Germany and the UK do. To work through these productive relationships is a good way to advance on this. LSE has been at the forefront of research into risks that could trigger the next financial crisis, and to develop tools to help policymakers and financial institutions become better prepared. This is the specific focus of our ESRC-funded Systemic Risk Center, which has played a leading role in putting together today's event, and it's also central to the research agenda of many different thinkers across LSE departments as well as throughout Goldman Sachs. So I'd like to thank not only Jim, the Minister, the State Secretary, but all of you who have contributed to this discussion and today. Thanks very much.